The Panic of 1907 was a financial catastrophe in the United States. The bank run on one of the largest trust corporations in the country at the time, the Knickerbocker Trust Company. It began on October 22, 1907, after rumors began to spread that the bank was in trouble. Customers began to withdraw their deposits en masse, causing a liquidity crisis for the bank. Despite attempts by the management of the bank to restore confidence, the bank run continued, and the Knickerbocker Trust Company was eventually forced to suspend operations on October 23, 1907. Several factors caused the Knickerbocker Trust Company bank run. Trust companies, which were unregulated and risky, emerged. The United Copper Company's collapse echoed through the financial system. Lastly, the Panic of 1907 eroded faith in the banking system. J.P. Morgan was a prominent banker and financier during this period. He was instrumental in the efforts to prevent the Panic of 1907 from turning into a full-blown economic crisis. However, he was also known for his business practices, which included consolidating industries and eliminating competition. In 1903, Morgan famously said, "I think it is just as well that there should be a little competition in business. If you have too much, you will destroy the business altogether." This quote reflects Morgan's belief that competition was necessary, but too much competition could be harmful. Morgan's views on competition were controversial, and he was often criticized for his business practices. However, he remained an influential figure in finance, and his actions during the Panic of 1907 helped stabilize the financial system and prevent a more profound economic crisis. The financial landscape has changed drastically since the days of J.P. Morgan and the bank run of 1907. Still, some patterns seem to endure, as seen in the recent receivership of Silicon Valley Bank and Silvergate. Once again, J.P. Morgan Chase, the namesake of the legendary financier, along with other banking giants, finds itself in a position to save smaller banks like First Republic Bank potentially. It's an intriguing development that mirrors the events of over a century ago, begging the question, does history indeed repeat itself? The reasons behind Silicon Valley Bank and Silvergate's difficulties varied, including rising interest rates. Still, the consequences were all too familiar. Fear and uncertainty threatened the financial system's stability. By propping up smaller banks, J.P. Morgan Chase and its peers demonstrated their ongoing influence and power within the banking industry. It is important to remember that J.P. Morgan's legacy is shrouded in admiration and suspicion. Many still wonder whether his role in the Knickerbocker Trust Bank run was that of a savior or an opportunist seeking to eliminate competition. The tale of the Knickerbocker Trust Bank run and the more recent struggles of Silicon Valley Bank and Silvergate illustrate the cyclical nature of financial crises and the critical role that powerful institutions like J.P. Morgan Chase play in shaping the economic landscape. As we continue to explore the financial landscape and draw parallels between the past and present, it is impossible to ignore the meteoric rise of the cryptocurrency market. With traditional banks like J.P. Morgan Chase feeling the pressure of this new financial frontier, one must wonder if history is again repeating itself and whether the recent struggles of Silicon Valley Bank and Silvergate might be connected to the evolving battle between fiat money and digital currencies. Cryptocurrencies, with their decentralized nature, have long been seen as a potential threat to the traditional banking system. With the ability to bypass centralized control and empower individuals to manage their assets, the rise of digital currencies has sent shockwaves through the financial world. Some speculate that the rumors which led to the bank runs on Silicon Valley Bank and Silvergate were not random occurrences, but rather a carefully orchestrated rouse designed to weaken and control the burgeoning cryptocurrency market. By sowing panic and draining liquidity from these institutions, which were heavily involved in crypto, the traditional banks may have hoped to undermine confidence in digital currencies and maintain their dominance. However, this strategy could also have unintended consequences, as even some traditional banks might be caught in the crossfire. The interconnected nature of the financial system means that the stability of one institution can have far-reaching effects on others. By draining liquidity from the market, traditional banks risk damaging the cryptocurrency ecosystem and inadvertently destabilizing their foundations. In this complex and evolving financial landscape, we see echoes of the past, with robust institutions like J.P. Morgan Chase potentially playing a role in shaping the fate of their competitors. Just as J.P. Morgan's actions during the Knickerbocker Trust Bank run remain shrouded in mystery, so too do the motivations behind the rumors that led to the struggles of Silicon Valley Bank and Silvergate. As the battle between traditional banks and cryptocurrencies continues to unfold, it is crucial to learn from the lessons of history, acknowledging the delicate balance within financial markets and the potential consequences of unchecked power. The tale of the Knickerbocker Trust Bank run, modern banking, and the cryptocurrency connection is a stark reminder that in the world of finance, the stakes are high and the game is constantly changing. While the high-stakes financial game between powerful institutions and emerging markets continues, working people like me and you often bear the brunt of the fallout. as history has shown. However, individuals can leverage these events to their advantage and secure a brighter financial future. By learning from the past and taking practical steps, everyday people can emerge as winners in the economic game, just as some did following the Knickerbocker Trust Bank run. The financial chaos resulting from the Knickerbocker Trust Bank run and other similar events often leads to widespread economic disruption, job losses, and diminished savings. Yet, amidst the turmoil, there have been instances where individuals managed to capitalize on the opportunities presented by these crises. For example, after the 1907 bank run, some savvy investors took advantage of the market panic to purchase stocks and assets at significantly reduced prices. As the economy eventually recovered, these individuals reaped the benefits of their foresight and strategic investments, positioning themselves for long-term financial success. To replicate such success, everyday people can take several practical steps. 1. Educate yourself. Gain a deeper understanding of financial markets, investment strategies, and economic history. 2. Diversify your investments. Rather than putting all your eggs in one basket, spread your investments across various asset classes and industries. 3. Develop a long-term strategy. Focus on creating a financial plan that aligns with your goals and risk tolerance. 4. Be patient and disciplined. Successful investors often exhibit patience and discipline in decision-making. 5. Stay informed. Keep up to date with current events and monitor the financial landscape. As we explore the financial game, the influence of powerful institutions, and the strategies for everyday people to achieve financial success, one can't overlook the rapid rise of artificial intelligence and its impact on the economic landscape. AI is transforming how businesses and industries operate and presents an unprecedented opportunity for a more level playing field if individuals are willing to adapt and embrace the change. From Microsoft Copilot, Stanford Alpaca Cloud, OpenAI, ChatGPT, Google AI tools, and Ernie, AI has the potential to disrupt the job market and create new challenges for regular folks. It also poses a threat to the elite, however, who may see their traditional sources of wealth and influence diminish in the face of automation and technological advancements. Humans go from good to better at all costs, even at eliminating good. This changing landscape could reshuffle the economic order, creating new opportunities for those prepared to seize them. For individuals looking to capitalize on this shift and reset the economic playing field, the following steps are worth considering. 1. Embrace lifelong learning. The job market will demand new skills and expertise as AI and technology evolve. You can thrive in an AI-driven world by committing to lifelong learning and staying current with technological advancements. 2. Invest in AI and technology. Consider allocating investment portfolios to AI and technology-based companies or funds. As these sectors grow, they may offer significant returns and opportunities for wealth generation. 3. Leverage AI to your advantage. Explore how AI tools and applications can help you make better financial decisions, streamline your investments, ease your workload, or even identify new opportunities in the market. By harnessing the power of AI, you can stay ahead of the curve and gain a competitive edge. 4. Collaborate and network. As the economic landscape shifts, you must forge connections with like-minded individuals who share your passion for AI and technology. Collaborating and networking allow you to access new ideas, opportunities, and resources to support your financial growth. 5. Advocate for responsible AI development. Encourage AI technology's ethical and inclusive development, ensuring their benefits are shared equitably and contribute to a more level playing field for all. Promoting responsible AI can help shape a future that benefits everyone, not just the elite and their corporations. The rise of artificial intelligence presents a unique opportunity to redefine the rules of the financial game and empower individuals to claim their share of the economic pie or create a new one. This is Sean Speaks, and remember, brain health is mental wealth.